Okay, so welcome to our training today. We're going to be looking at enhancing your trading by adding indicators to your charts. Today's training is so if you don't have any trading experience at all, if you're new and you're here for the first time, you might want to go and watch the previous courses so that you have a better foundation because we'll be talking about things that we're going to be talking about things in a way that assume you already have an idea of the market. But that said, I'm going to make it as simple as possible as usual as we embark on this journey. So today we're going to be looking at enhancing your trading using indicators. You know me. It's important that we put out a disclaimer here to let you understand that there are risks associated with forex trading and you want to trade with money that you want to trade with money having in mind that there are risks and losses arise that could arise from the market. Now, that being said, we're going to be looking at indicators as said. You've probably seen a lot of people's charts, maybe online, you've seen charts of maybe people who are potential who are traders, or at least they say they are traders. Sometimes one of the things that scares you off is when you look at their chart and you know, you see a lot of things. Now, indicators are very powerful tools if used properly. The mistake is that a lot of amateur traders end up filling up their charts with indicators to the point that it causes analysis paralysis, meaning there's just so much on the charts that you can't even really see what is important, and you keep analyzing and until there's no you can't even see where to enter the market. There's no entry, you can't see entry, you can't see exit. Now let me show you what a chart would look like. So you've probably seen something like this. Now you've seen traders with this kind of charts or with this kind of screen, and you'll be like, wow, what exactly am I seeing? What you see here is just chaos. There's a lot of things here. You can't even really see price. There's just a lot of things going on here. These are indicators, but when used like this, it's probably going to do more harm than good. So we're going to look today at how not to do this and how to actually use indicators properly. We're going to majorly focus on some few key indicators which I personally prefer and to use the way I use them. Now, I like to put this out. Da Vinci said that simplicity is the ultimate sophistication. And when it comes to trading, you want to have this at the back of your mind. You want to think like Da Vinci. You want to make it simple. You want to make it easy for you to see what is in the market happening in the price on your screen on the chart. And so that means not overly complicating yourself or overly complicating the chart. So while we're going to use indicators, you see how I'm hinting that you don't want to now flood yourself with indicators or use indicators to the point that you take it to the indicator signals to the bank. Indicators, what they are, they is more like mathematical calculations depending on what it is set for. So it's used to see what price has done in the past, or try and track some things, and then show you maybe a possible turnaround of event, a possible outcome of event. It doesn't mean that you see maybe the indicator says buy and you just says okay, it's correct, and you buy. If you notice, all we've been doing on our course, we've been doing layering, meaning we've learned from baby steps, we've taken price action, we've added on top of it and adding on top of it. So everything that we've been learning is all about placing it on top of each other in order to enhance our trading. Now, let us go to our charts. Okay, before we do, let's look at some of the indicators we'll be seeing today. Now, there are four major indicators that we're going to be looking at today. So the moving average, the RSI, the stochastic, and the fractals. And these indicators are already readily available on your charts. They're already available on your MT4 app, whether you're using the mobile phone or you're using the the desktop version. You have these indicators embedded built in your app. So we're going to look at them, kind of explain what they are and how we can incorporate them in our trading. Now let's move to our charts. No, this is a mess. So remember, you don't want to do this. Let's take up a new chart. Pick something nice plain here. Okay, let me take off everything here. Okay, so we have a fresh chart. Now, if you're using your PC, your laptop, your desktop to do your trading, you can easily find your indicators in the insert tab. So under insert, you'll see indicator list. That's where you see insert indicators and you see all the indicator list. If you're using your mobile phone, on your chat screen, if you just tap anywhere on the screen on the surface, you would see a round something like a round set pop up with time frame, and then somewhere down you see a button that looks like, I don't know what to call it, maybe like a cloud. So if you click on that, you would have it will show you where to where your indicators are. So if you click on it, you click on that. I think there's an F button. So if you click on the F button, you can now add indicators to your charts. I think you'll be able to figure it out on your mobile device. It's actually straightforward. So what I'm going to be doing here, you can also apply on your phone. Although I prefer to use desktop to trade. Now, the first one we're going to look at is the moving average. And what exactly is the moving average? Let me see if I can write that here. So the moving average. So we're going to be looking at moving average first. So what exactly is the moving average? Well, the moving average is a trend indicator. It's an indicator that helps you kind of like see the trend or follow the trend. Now, the way I use moving average is there are three major moving average I add to my chart. And that's when I'm looking out for something. So I add these indicators to my chart. And here's how you add a moving average. You go to insert, you go to indicator, you go to trend, and you'll see moving average here. As if you're on the desktop version. If you're on the mobile version, you'll be able to figure it out. You click on the F button and then click add and look for moving average. So if you click on the moving average, you have this dialog box pop up where you can impute parameters. Now, I use two moving average to follow the market closely, more like a mean. I use them as a mean. If you remember your mathematics, you know that there's mean is like the average. So what usually tends to happen is the market always tends to pull back to the mean. It always tends to come back to the mean, and even if it goes very far off from the mean, it usually tends to pull back to it. So I use the 20 exponential moving average and the 50 exponential moving average to kind of like follow the market and see when the market is very far off from the mean. Then I also use the 200 EMA or the 200 exponential moving average to kind of see the overall trend of the market. So now let's add one. Let's add the 20 period moving average. So under parameters on the period, if maybe you might have something like 14 there. You can use 14. There's no this is not a hard and fast rule. You at the end of the day, you probably figure out what works best for you. Personally, I like to use the 20 EMA and the 50 EMA. Some other people uses the SMA, that's the simple moving average. Some people use the smooth, but I prefer to use the EMA because I think from application it works good, and I apply it to the close. So once I have this, I click on OK. So if you notice, you have this line. I don't know if you saw it. Let me remove it and do it again so that you can see the difference. So if you look at the chart now, it's just but now when I add the moving average, go to insert, indicators, trend, moving average, it's 20 EMA, and I add, you can make the line. Let me make the line thicker so we can see it. Like click on this, you can see this line. It's more like a line that is moving along with the market. As you see, this is moving closely with the market. So this is the 20 EMA. So what I like to do is add another. So I'll add another moving average too. Go to trend, do the same thing. And then this time, instead of 20, I'll add the 50 EMA. And to differentiate it, I will make it a different color. So let's make it blue, and then let's make it bold too. Okay, so we can see the difference. So remember, the red is the 20 EMA, or the 20 period moving average, and the blue one is the 50 period moving average. So now what you see here is you see a chart with you see how the moving average moves with the chart. In an uptrend, in a very strong uptrend, what you find is price is always above the moving average. So in this case, you can see how price is above both the moving average. In a downtrend, price tends to stay below the moving average. If it's in a sideways trend, you see price action is just being choppy, and the price, is just mostly cutting across the moving average. Now, you can see here, this is a downtrend. The price stayed below the moving average. But you notice, like remember I said, I use it as a mean. The one as a mean, what happens is the market always naturally tends to pull back to the mean. So you can see how price, it's going down, but it keeps coming back to the moving average before and moving down. So it's always pulling back to the mean and pulling back up. You can see in a downtrend, it keeps pulling back to the mean. Now the market is above the moving average. You can see how it is holding price above. Price is just gracing through it. Then the last moving average I want to add, and this is just for trend following, is the 200 period moving average. So this one would be much wider, as you can see. Now, the 200 period moving average, I like to use to identify overall market trend. You see how it's far off. That means, okay, let me change so it looks different. Let's make the 200 period moving average, let's make it green. Okay, so once if the market is below the 200 moving average, the market is in a downtrend. When the market successfully breaks above the 200 moving average, so if I want to see the overall trend, if I just put it inside my 200 moving average, 200 period moving average, I can see that the market is in a downtrend. Price over time had been staying under it. Now, you see here where the market crossed above the 200 period moving average. Now, prices, as long as price keeps staying above this, so even if price comes back down here, as long as it stays above the 200 period moving average, the market is, the market is said to be in an uptrend. And this, when you draw your average, insert your moving average indicators, it will just occur on every time frame. So it's there for you on every single time frame, from the daily to the weekly to the monthly and what have you. So for the 200 period moving average, I like to look at it mostly on the daily time frame, daily and the weekly time frame, because the higher time frame will help me see the overall trend. On the weekly time frame, I can see that the market is now bearish. Like the market has been bearish, meaning it has been staying below the 200 period moving average for a while. But now notice that you can see that the market is just crossing above, or at least it's trading almost at the 200 period moving average. So if the market successfully stays above the 200 period moving average, it all goes to indicate that the market that has been bearish for a while, and this is a long time ago, the market has been bearish since this is 2013. If it successfully cross above and start heading higher, then the market is now in an uptrend on a longer time frame. Now, note that a market that is in an uptrend in a longer time frame might be in a downtrend in a lower time frame. Like this is the 1 hour time frame. You can see how the market is below it. So you want to use the upper time frame to understand market direction. So you gauge market direction. So if the market is in an uptrend on the weekly time frame, on the daily time frame, then you want to be looking to buy. Like you want to be looking for buying opportunities, because the overall direction of the market in a bigger time frame is up, and vice versa for when it's down. So I use the the 200 period moving average and the other moving average this way. Now, another way you can use this, another way you can trade off the moving average is this. When the market is in an uptrend, like we said, it stays above the moving average. When it's in a downtrend, it stays below the moving average. Now let's look for a period of uptrend. Let's look for a period where the market is in an uptrend. Okay, we have one here. So here you can see that the market has been in downtrend. This is a downtrend. Okay, we can use this. You can see that the market is in a downtrend clearly, and you can see how price stayed below the 200 EMA. Now, one way you can trade this, like for example, the mistake a lot of traders do is if they see price heading lower. Price is, let me zoom in more so you can see more of the chart. Okay, so let's say here, for example, so you see the price make this engulfing bar and then start heading low, start heading down, and they see this and they're like, wow, okay, so the market is going to drop to here straight up. So from here, it's going to drop down to here. But what they don't get is the market might just be too far off. Let me see if I can kind of like. So let's look at this now here. So the market at this point, you can see how far off the market is from the mean. It's quite far from the moving average at this point. And so what happens is when the market found kind of like a support here, it's now aided it and helped it pull back to the mean before it's now started going down again and eventually to here. So this is what I mean when I said use it as a mean, because the market tends to pull back to the mean, as it's moving in the overall direction. So the market pulled back to the moving average and continue down. Now, I can use this as an end, use it to enhance, like if I'm thinking of selling this trade, if at this time I was thinking of selling this pair and the market was here, I probably would now, I would definitely not take this trade because it is far from the moving average. So what I'll do is I'll wait for the market to pull back to the moving average, and then I can now take the trade. And then the moving average would also help me in this case to understand where to place my stop loss in case the market decides to move against me. So as the market has formed this rejection here, I can now take the trades, place my stop loss above the moving average and above this candle formation here. This way my stop loss will be, and then I can now start taking the trade down. So let's say if I can also use it to gauge exits. When the market is okay, I've been selling and then the market has pulled back down to this place. It has not touched come back to meet the moving average in a while. And then it is also approaching a support level. So in this case, what I would have just done is to signal that okay, let me lock in my profit. So let me take some profit and wait for the market to do what it wants to do. So maybe I take out profits and then you see the market retrace. And then if I still, depending, if based on my analysis, I still feel the trade is still sound and I continue taking the trade. But you can see how the markets keep grazing the backside of the moving average and then heading down in this downtrend or this bearish market. It is also the same in a what do you call it in a bullish market. The market, the price will stay above the moving average. But if it's a sideways market, that means the market is not really making ground. You see how price is just chopping, just cutting in and across the moving average. Another way you can also trade the moving average is if you see price, pull back to the moving average and hits or tests, the 200 EMA at a resistance, at a area of resistance or support, that might offer a good trading opportunity. So you see the market pull back and then, test this moving average, the 200 EMA. That is the outer moving average that indicates overall direction. Some traders can use this as an entry rule to trade once they see a rejection from the 200 EMA, and then you can now figure out where to place your stop loss above and then target your next take profit level. And that is how you can see how the moving average works. In an uptrend, the market stays above it. In a downtrend, the market stays below it. Another way people use moving average to kind of like figure out turn around in the market. Remember, the 50 EMA, this is the 50 EMA, would always stay below the 20 EMA in an ascending market. In an ascending market, the 50 EMA stays below. In a descending market, the 50 EMA stays above. When you see when a moving average cross occurs, it usually tends to signify that the market is now about to switch from maybe from bearish to bullish or from bullish to bearish. So you can see in this case, you see where the market, okay, this is a sideways trend. Let me look for when the market went from bearish to bullish. So you can see in this, let me kind of like, so you can see the market here. If I could just show you the selection. Okay, so this is the period you're looking at. You can see the market in a downtrend staying below the moving average. Now, the market has started making higher highs and heading upward. But it is still, at this point, the market is even still in a downtrend. When the market, first of all, broke, heads above the 20 and the 50 EMA, you see that there's a moving average cross. Formerly, the 50 EMA was above. And then at this point, the 50 EMA crossed and went below, and the 20 EMA went above. At that same point, if I can zoom in, you would see that the market formed a pin bar rejection from that place and a bullish engulfing from that place. So this can also be a way you identify entries. Moving average cross. So you see that the market has crossed, the moving average has crossed from bearish to bullish. It formed a bullish pin bar, a bullish engulfing bar. You now have an idea of where to place your stop loss. You take the trade. So let's say you enter the trade at this point. You place your stop loss below the moving average and below your formation, maybe here, and then your entry is here, and you can now run the market up to the next level of resistance. You see how that works? So the moving average cross, let's scroll back in time and see several other examples of where the market crossed over. So when we're looking at the market that has been maybe bullish and then is now becoming bearish. So in this case, the market has been bullish, and then here you had a moving average cross, and you can see how it formed. You have the moving average cross. On top of that, you have this bearish engulfing bar. So this can now probably give you an insight into trading, and then you place your stop loss above this high, above the moving average, and then you can now place your targets depending on what exactly is maybe the next support level. But you can see how this entry, the moving average cross here, you have a moving average cross here that would probably give you a good idea of where to enter the market. You have the same thing here. I can show you over and over and over again. So you have a market that has been bearish or bullish. Let's look for where it has been bullish and then turns bearish. Okay. And this works on all time frame. You can apply this same strategy on all time frame, 4 hour time frame, the daily time frame. But remember, like I said, you use the higher time frame to figure out the overall direction of the market. Then you can now use the lower time frame to figure out entry and exit. So you can see the market is being bearish. There's a moving up, then there's a moving average cross, and you can see how the market started heading to the top. So this is just one. Now let's look at. I think we'll spend enough time on moving average. You have questions, you just type them down. When I'm done, we'll look at them. The other indicator we want to look at is the RSI. RSI stands for Relative Strength Index. Now this is used to kind of figure out areas where the market has been overbought or oversold. And so personally, I use this to figure out, help identify areas where the market has been overbought, oversold. Now, if you think about it, if the market is overbought, that means buyers have pushed price too high. So what you see likely is the market reverse back to the mean or to the moving average. And then if the market is oversold, you probably will see the market, retrace back to a higher price. So you can use the RSI or the Relative Strength Index to kind of figure out in combination, remember, in combination with your other trading strategies to identify areas of pullback. So remember, the moving average, we use it to identify trend direction and trade in the direction of the trend. But the RSI, we use it to identify areas of possible reversal. Now let's see what that looks like. Let's take this off and take this off and take this off. Okay, so we're going to still leave our moving average there, and then we're going to insert uh, RSI indicator. So you still go to insert indicators, you go to oscillators, and then you go to relative strength index. So you add that to your chart. The parameters you want to have, you can have some people, it might be 80-20. You can set your levels to be 80-20. You can set it to be 70-30, so that you use the low as oversold and the top as overbought. So let's leave it at 70-30, and let me change this to something that is more visible. And let's make this line, let's make it thicker so we can see it better. Okay. Now, this is what the RSI looks like. This is the 70 and this is the 30. So you have the top of it as 100 and the bottom of it as 0. Now, what this is trying to show you is more like showing you the volume, like an oscillator that shows you, you know, how much price has gone in relation to demand and supply. So what I mean by that is this: if the market is very low, close to the, to zero, it means that the market is oversold. Now, when the market is oversold, it tends to, pull back up, equilibrium. It tends to balances out. And then when the market is overbought, it tends to pull back down. Now, this is how you can use it in your chart. Once you have it set up in your chart, you can now look at where price is. So, for example, if you were looking to buy, let's say, you remember our overall trend of this market is that the market is still in an uptrend. But if you're looking to buy this market, for example, and you now decide, okay, you just take your trade and buy here. This price is too high. If you follow this my crosshair, you can see where the price is in relation to the RSI. That particular price point is in an overbought region. So if you buy this market at this high price, RSI is kind of like indicating to you that that place is overbought. So, and mostly you can see based on the previous chart, when the market tends to get to, when the RSI points that the market is in an oversold region, the market tends to pull back, even if it's temporarily, but at least it pulls back. And then when it's in an overbought region, it also tends to pull back. So now in this case, if you have done your analysis and you wanted to buy, and then RSI tells you that the market is in an overbought, you might be better off waiting for the market to make a move back, at least for RSI to point to move back and come to around the oversold areas, which will now probably offer you a good or a better trading opportunity. So this way, you will not be buying a market that is too high or selling a market that is too low. So this is how you want to apply the RSI, the relative strength index. Use it to figure out areas whether if it's a good time to enter a trade buying, or maybe it's a good time to enter a trade selling, or maybe you should just probably wait for the market to make a move, or maybe retrace back and RSI to show you that it is a good time to enter. Now, remember, I'd like to point this out. You do not want to use these indicators as, you know, take it to the bank. Let me put it like that. You don't want to use these indicators in a way that once you see price in oversold, you start buying. Or you see price in overbought, you start selling. You don't want to use it that way. What you want to use it is to, it's like you're trying to make sure that your trade is sound. So when based on other analysis, you've seen that, okay, this is what you should probably be looking out for. Then this is how you apply indicators. Use indicators in a way that you use it to make a better decision. That is why when you look at most of my charts, you will not really see, I will not have them on. I will only pull them out and use them when I want to confirm. So if I've decided, okay, this is what I probably want to do, then I want to confirm, then in that case, what I'll do is now probably look at where the price is on this pair. So now for this pair, for example, here's what I would do, or this is something I have on my other chart. Now this area here is an area of interest. You can see how price has been staying above it. And then when it came below it, price has been staying below it. So this is an important area. Now, and the market has crossed and is now it has been in a bullish market. It has been in an uptrend since, but the market is too far off. Meaning, even though I think the price will still go higher, I'm anticipating more move higher. The market is too high, far off for me to be buying. That's the way I see it. The market is still too far off for me to be buying. So when I pull up my RSI, I can see that that market is also is in an overbought area. So what I would like to see is market to pull back to a level, probably very likely this level, because this level is an area of interest, this particular level here. And then maybe for RSI to indicate that the market is in an oversold region. And then in this case, to find price action, show me that the market is now rejecting this level. You see how I piece three things together? I draw up my support and resistance level. I see that the market is above, the trend line, the moving average is showing me that the market is in the bullish trend. I can see that the market is above the trend, the moving average lines. RSI is showing that it's overbought. So I'm not looking to buy now. So what I'll do, since my bias is long, buying, because the market overall is in an uptrend, I'll wait for the confirm market to confirm that. So if we now see RSI come down here, market pull back. Remember, RSI doesn't move on its own. It moves in relation to price. So it's what happened here that will reflect, how this would be. So if price moves down back to this region and RSI is showing that the market is in an oversold area, the market is currently oversold. And then from here, you now probably see something like a bullish pin bar rejection from here, or a bullish engulfing bar, or a three right and three white scroll, or something like a bullish formation here. It will now confirm that overall bias, and I can now start looking to trade in the direction of the trend. So now it is not a certain that the market will bounce from here. The market could actually pull back and retest the 200 EMA before moving back up. But a confirmation of everything put together would help me make a better trading decision. And that's the RSI. The next one I would want to talk about is the stochastic. The stochastic is almost like the RSI. They are both oscillators. So what I'll do is I'll take off the RSI. Let me delete this, delete indicator window. And then I'm going to add the stochastic. So go to indicator, oscillator, and I go to stochastic oscillator. I hope you saw what I just did. I did insert indicators, oscillators, and then stochastic oscillator. Now, in the stochastic oscillator, there are parameters I like to use better. The parameters I prefer to use is the 533, and then I like to apply this to the close, and it's exponential, so it uses the exponential EMA. You might change the color so that it's something you prefer, and then make it like a solid color or something. Okay. Let me just make this solid so that it's more visual. My screen might be small. Okay, so we have it there. Now, this is too bright. Okay, now what you see here is the stochastic oscillator. The way the stochastic oscillator works is similar to the RSI, or the relative strength index. It shows us overbought and oversold region. And then you can see when the market is at an overbought region, it mostly tends to pull back down. When it's an oversold region, the market tends to pull back up. At least when stochastic shows you that the market is oversold. We see a pullback to the top, and when stochastic shows you that the market is in an overbought region, you see a pullback to the bottom. Now, the difference between stochastic and the RSI is because stochastic gives you dual visual lines. So what I mean is this: you can see that we have two separate lines with two different parameters. The In the RSI, you just have one line. So what we're looking at here, or what this is you have the 2% or the D percentage. If I go back to it now to show you, let me show you what it looks like. Okay, so you have the K period, percentage K period, and the percentage D period. Now, if you look at, okay, look at the color visualization here that I used. So we have the red one to be for K, and the red one to be for D, and the blue one to be for K. Now, you see that when the market is down, when stochastic is showing you that it is an overbought region, you have the red one above. Now, when you see a cross like this at the bottom, just like the same way we applied moving average crosses in an oversold region, then you're likely to see a price move up, move back up. It may not necessarily go back to overbought, like you can see in this case. There's a cross of stochastic, and then the market went up, but not far up before pulling back down. But this alone, the crosses, you can now use it to decide, okay, is the market in an oversold region? Has the K percentage crossed over the D percentage? When you tally that up in the same way we did with our moving average, so in this same trade that I was talking about, now you see that stochastic is showing that the pair is in an oversold region. But RSI is not yet in an oversold region. So I'll probably stay away. Now it doesn't mean that all of them have to tally. But personally, because I'm looking at this level, because I've been looking at this is the key area of importance or key area of reference, because the market just went straight up without pulling back very much. So at least I'm expecting a pullback to this region. At least maybe before the next move higher. The market may break down and continue heading lower, but at least a pullback to this period would make sense. So this is how you use the stochastic. This is how you use the stochastic in order to identify the direction of flow, whether the market is in an overbought or oversold region. And then the last one that we're going to talk about is the fractals. So the fractals is I use it to identify the highs and the lows, and majorly I use it to figure out where my stop loss should be. So use it to identify the highs and the lows, and then use it to figure out where my stop loss would be. Okay, so where is my fractal? Yeah. So under Bill Williams, you have fractals. Now, once I click on, you don't need to do any much. You just select the color you want it to be, maybe make the thickness, and then click OK. Now, what it just does is identify, it just clearly points out the highs and lows, marks it out. Declare by highs and lows is turnaround period. Now, it is not, you know, correct to the letter. That means it's not 100% accurate. But you can now use it to see where the lows or the highs of the market are. So in an uptrend, remember in an uptrend, you are looking for buying opportunities. When you identify a buying opportunity, now for example, in this case, the market rallied up, then pulled back, formed a low price. This is the low price, the fact that I identified it, and then formed something like a bullish engulfing bar. Now, if you decide to buy this market after the close of this bullish engulfing bar, my stop loss, I use the fractal to identify where I'll place my stop loss. So my stop loss will now be below this fractal low. So I'll place my stop loss below this fractal low. And then remember, all of this would have not happened. And then I can now target the next resistant level. And then when the market gets to that place, maybe it pulls back, forms a new low. Now, if my overall target, because sometimes I may have a trade where my target is here. So from the point of entry, I have a target that is maybe 200 pips away or 500 pips away, sometimes more. But I would not want to just allow my trades to run, especially once the trade is moving in my direction. So what I mean is, let's say I bought this market here, and I'm targeting to here. The market has rallied back up, pulled back, rallied back. Remember, my stop loss will be placed here. Rallied back, pulled here, gone up again. I would not like to leave my stop loss here because if the market does something like this, runs down, it will now take me out for loss, and then I'll take a loss. I'll now take a loss after I've seen all of these profits. So what I do is that the market moves up in my direction. I will keep going back to adjust my stop loss, editing my stop loss, so that it now, so if the market has formed a new low price here, I'll adjust my stop loss to go from here to here. Then when the market forms a new low price, it's not just when it forms a low price. When it forms a low price and has now started as rejected and started pulling back up, I push my stop loss below the fractal low. Once it has rejected again, started heading high, I'll put my stop loss below the fractal low. The same way below the fractal low, below the fractal low. Now, if this is my target, once it gets here, I would have taken off, taking my profits. But let's say my target is still far off, and then build okay it did not break out here, but what could happen is the market could at some point, let's say I place my stop loss below this fractal low now. At some point you can now see the market, instead of going up again, go down and take me out. In this case, I would have taken a profit, a lot of it, even though it hit my stop loss, it would have been profit for me because you've seen that I've been adjusting my profits, my stop loss to the point where it is now in profit. And that is how I prefer to use the fractal. So I use it to figure out low prices. Although you can easily spot it on your charts, I don't really use it so much these days because I can easily see it while I'm looking at it. But you can easily look at it to see where the low prices is in an uptrend and you're buying the market. You can also use it to identify where the high prices is or are in a downtrend and you're selling the market. So if the market is in a downtrend and you're selling, you're going to be looking out for the fractal highs in order to identify where your stop loss should be, especially once you're moving your stop loss in the direction of your trade. So in this case, if I'm selling, my stop loss would be, let's say I sold here, my stop loss would be above the fractal high. If I sell here, my stop loss will be above this. And if I'm adjusting my stop loss, I keep moving in the direction of the fractal. So if you now add all of these things that we've talked about, you don't want to overcomplicate it. As a matter of fact, you might want to just pick out one. The one you maybe it's moving average. I like the moving average. Maybe it's just the moving average. Just pick out the moving average and stick to it. Get good at it. Understand how it works. Understand how to trade it. Look at price action on it. Trade it on your demo. Trade it on your live. Get good at it. As you've gotten a mastery of it, then you can now start heading in the opposite. Add another one to it. Add another layer on top of it. Like here, you can see this is current. This is live market, so you can see how the market just touched the 50 EMA, and it is rejecting price. So this is how you use these indicators. Now there are a lot of indicators. If you look at insert, there are a lot of indicators here. There is another important one too is MACD, but we'll not talk about it. Also oscillator. I use average true range. Gator, but there are a lot of them here. If you confuse yourself by adding a lot of these things, you just, it's just your trade. You will not be able to see what is happening in the chart. In order to make money in the forex market, you want to be able to see the chart. Like you want to be able to understand what price is saying, because these oscillators or these indicators, they only tell you in relation to what has happened. They don't tell you what is going to happen. They tell you what has happened, you know, and what is happening. So, but being able to see the charts and understand cleanly what's going on the markets, on your chart, would now put you in a better position to make better decisions. Because if you just pull up oscillators and indicators and all of them, you're not really looking at the charts. You're just looking for, is the market oversold? Buy. Is the market overbought? Sell. You make some money, but you make a lot of losses because you will soon realize that trading indicators by themselves, you know, may not, it's probably not the best way. At least what I found. I've done that, while I was learning, I've used indicators, but I think trading indicators by themselves would not be so much good. So you want to add it in conjunction to your analysis and price action. So I think, okay, so that is what we have on this. And let's take your questions. Okay, so Kerry said, why did I use 50 or 20 and 50 as parameters for the moving average? Okay, well, it's how do I put this? You can put whatever you want there. You can use, some people use the 14 period moving average, some people use the 20 period moving average. But from doing this for a long time, I personally, the 20 and the 50 works best for me. Like, I don't want, sometimes, like, if I use the 14 period moving average, it is too close to the market. Now let me take this off. Let me see. Let let's add some other indicator. Let me take all of them off. And let's add a 14, because one other one people use is the 14 and 20. So you can use the 14 and the 20 period moving average. So maybe 14 and 10. You can use 5. You can use whatever you want. It would also trend the market, but in my for me, it is usually too close to price. So it's usually too close to price, and then you have price, taking it out many times. You have price taking it out at some point, more often. It's also the same thing if you use much higher ones, like maybe a 60 or a 100. You will have a situation where it's, price is never really getting there. If I use 100, you have, okay, they are both the same colors, but you get the gist. It is too smoothened out that I can't really work with it. So with by over the time, seeing what other traders do, seeing what works, all works for me, the 20 EMA plus in combination with the 50 EMA enables, remember, the way I use them is to help me, guide me and show me the mean in the market, in the direction of the trend. So it's easy for me to spot the mean, spot what the market is doing at those times, spot how the market is moving in connection with the moving average. And so the 20 EMA and the 50 EMA tends to work best for me. But remember, you're in the learning phase. You can try out moving average and see what works well, And that's the beautiful thing about forex trading. There are a million and one styles, a million and one traders, different types of traders. So you have to just stick to what works for you. Figure out what works for you and then do it. Stick to it. Maybe what worked for you is good because of the time frame you're trading. And then it may not work for somebody else because the person is also trading at a much different time frame. So that's the reason why I use the 20 period and the 50 period moving average as my parameters. Remember, these things on their own should not be the basics of your trading decision. You want to put it in connection with all the things you've been learning. So your price action, as a matter of fact, your price action, understanding of price action and understanding of support and resistance is the most important. You may not even need to use any indicators at all. If you get good at price action and so understand being able to draw your support and resistance level and trend line as well, you will not probably need any indicators. For most of my analysis these days, I don't even use any indicators except the moving average. So it's good to put out this information because for other types of traders, it might just be the most important one. It's good. That is why I'm teaching you everything that needs to be learned, but you want to take it one step at a time. Like my boss would always say, slow is fast. So you want to master one, move on to the next, get so good at it. You know, don't just be good at them. Don't know how. Don't be good in you know 10,000 kicks. Instead, master one kick 10,000 times. Don't practice 10,000 kicks, but practice one kick. If there's one technique, if you're a fighter, so that you can learn how to, throw a jab or a punch or whatever, maybe a kick. If somebody knows 10,000 moves and you know one move 10,000 times the way he does, you probably have the edge because you would have perfected that move to the point where your one jab, would be worth more. So that is why you want to, while you're learning all of these things, you put them into application, but do it progressively. Build layers and add one on the other.